Good morning. This is Mark Boud of Real Estate Economics. Thank you for joining us for our Wasatch Region Economic and Housing Market Trends and Forecasts webinar. This is part of our YouTube series of webinars that we post every Wednesday. And we're thankful for those of you who are interested in this particular market where we have done an increasing amount of consulting during the past several months. Let me take you through the definition of the Wasatch Front. It is composed of the Salt Lake City, Utah MSA and Provo-Orem, Utah MSA. The vast majority of the population within these MSAs is associated with Salt Lake County as well as Utah County. Utah County is anchored by Provo, where BYU is located, and Salt Lake County obviously is anchored by Salt Lake City. We are the main economic consultants for a couple of major master plans in this particular market area. And so we've studied it carefully, both in terms of new housing development and sales potential, as well as price potential and even apartment potential in this particular market area. This pie chart shows the overall transactions that occurred in January year 2011 by market or by transaction type. In terms of foreclosures, properties being lost to the bank, that represented 23.1% of all transactions that occurred in January. That's higher than foreclosure sales, banks selling properties back to private owners at 18.6%. New home builder closings were only 6.9%, while resales were 51.3% of the overall transactions. That's highly abnormal for this particular market area. Year 2006 shows a more normal distribution of sales, with new home builder closings representing more like 12% of the overall market and resales representing about 85% of the market. I'm actually going to switch to our website right now. Here's the home page of our website. I've already logged in. I'm going to go to products. And to our housing transactions reports. And actually run the most recent report for this particular market area. Page down all the way to those two main counties in Utah, Utah County and Salt Lake County. We'll choose all of the cities in those regions, as well as all of the zip codes. And we'll filter it to just the month of January and run the report. So here are all of the transactions that have occurred in this particular market area, from in the north from Salt Lake City down to very southern tip of Utah County. As you can see, they're color-coded based upon the type of transactions they were, whether they be foreclosure sales, new home builder closings, or resales. Let's actually go to, let's actually run the report. And we'll go to my vault where my reports are stored, and we'll actually pull up this report in Excel. So here is the housing transactions report for Utah County and Salt Lake County for the month of January year 2011. Overall transactions increased by 1.7%. That's a good sign. They've actually increased now for 24 months from January year 2011 from the number associated with that posted a year ago and 2 years ago. It's a healthy sign when the overall transactions are increasing. And part of the reason they're increasing is because this area is an incredible deal right now. It's fallen significantly in price, over 16% during the past 24 months, about 10% during the past 12 months. Part of that is associated with, in fact, a large part of that is associated with smaller home sizes selling. There's a lot of larger homes that were built in the Wasatch Front during the past cycle, and now that buyers are becoming more price sensitive, it's the smaller homes that are in greater demand. As home size averages fall, the overall price falls. It's not necessarily depreciation during the past 12 months, because we've actually seen a fairly healthy increase in price per square foot, but there has been some depreciation during the past 24 months. In terms of what this looks like graphically, here are our price patterns where the absolute price has actually fallen while price per square foot has gone up during the past 12 months at least. In terms of transactions, there has been a slight decline in single-family transactions, but that's been more than made up by an increase in condominium transactions. If you were to look at the type of transactions, you can see that resales have actually fallen a bit. Foreclosures have increased, as have foreclosure sales. So this is worrisome in that part of the transactional increase has been associated with distressed housing. New home builder market share has fallen during the past 12 months, and foreclosure sales are lower than foreclosures. In fact, that's been the case for the past 24 months, and what that means is that distressed housing inventory is building up in this Wasatch Front area, meaning that it spells some problems as we go on. In year 2011. There's going to be a lot of distressed housing that competes with the new home market and the traditional resale market. For those of you who are interested, if you'll contact one of my associates, either Judy Duell or Sandy Rivera, I'll ask them to send this report directly to you so you can see it in more detail. Going back to the actual PowerPoint presentation, I am going to very quickly take you through some economic data and forecasts for Salt Lake City. Our measure of Salt Lake City is that it is now 5% oversupplied in terms of housing. That's not because they built too many homes, it's more because they've lost a lot of jobs during the past 24 months. The overvaluation of housing is 14%. Undervaluation of housing is now 14%. That is based upon a comparison of where prices and incomes are now relative to that long-term relationship between prices and incomes. And right now it states that it's about 14% out of whack to the positive, or undervalued. That's far less undervalued than a lot of other markets, partly because Salt Lake didn't inflate nearly as much as other markets and hasn't had to correct as much. We're paying about 18 cents on the income dollar for mortgage costs in Salt Lake City. That's down from 22 cents in the year 2006, the peak year. So it's dropped about 18%. It's a severe drop, and there's a lot of pain associated with that, but it's not nearly as severe as what we've experienced in some of the other markets that were just grossly overinflated. Las Vegas, Sacramento, Phoenix, and so on. Here's the overall ranking graphically. A 5-year forecast for the Wasatch Front region. Here is our modeled estimates of overall demand shown in green relative to supply shown in blue. The gap between the two is a representation of oversupply as it is now, or undersupply as it was during the year 2007, 2008. It wasn't until the early part of the year 2009 when we began to lose a lot of jobs and became oversupplied because of that. That difference between those two supply and demand curves is shown graphically here. Here you can see the oversupply. It's severe, but it's about as severe, or possibly even a little less severe than it was relative to the recession that occurred in the early 1990s. That is atypical for a region in the United States, where most regions right now are far more oversupplied now than they were in the early 1990s. Here are the patterns of valuation. The blue curve shows where prices actually have been, median home prices, relative to the green curve, which is where we think they should have been relative to income support and economic support. So you can see this bubble that formed. It started in year 2006 and it collapsed in 2008, 2009. Now we're actually undervalued. We actually have seen greater ability to support housing prices in Salt Lake City because we've dropped mortgage rates so much. Some of that is artificial, and over time as mortgage rates normalize and go up, we'll actually see this potential curve fall while there's appreciation in the market. But meanwhile, we are in an unstable environment in terms of undervaluation. It's not nearly as unstable, nor was the bubble nearly as severe as we've seen in other markets. For example, this is the Phoenix, Mesa, Scottsdale market. You can see the enormous bubble that formed earlier this decade, as well as the significant level of undervaluation that's there. Salt Lake City, again, is a market that did not get nearly as out of whack, and its correction has not been nearly as severe as a lot of other markets. But there was a bubble, and there has been an overcorrection. Graphically, that overcorrection and bubble is shown here. Here's the formation of the bubble, or overvaluation, that occurred in 2006, 2007, 2008. The subsequent collapse, and then the undervaluation is right now. In fact, we think it will actually become even a bit more undervalued this year, as we are forecasting a slight decline in price during year 2011. That lags the recovery that we're experiencing in at least coastal California and some of the other markets where we do analyses. Salt Lake City is 12 to 18 months behind that curve. Nonetheless, it is unstable, and this instability is almost as great as it was during the bubble period. It's just the flip side of that. What will occur is, as economic growth resumes in the Wasatch Front, we'll see appreciation as well as increases in mortgage rates until this is forced back to equilibrium and even an overcorrection over time. How that translates in terms of price appreciation is shown here. Here you can see the peak level of prices that occurred in year 2007. The subsequent decline, we think it declines further during year 2011 before it begins to march back up during the next 5 years. But even by year 2015, we don't think that it quite reaches the overinflated levels of 2007, 2008. However, it gets close. In terms of the percentage of appreciation or depreciation, we're forecasting a 3.4% drop during year 2011, followed by a mild increase in price during year 2012, and an increasing level of appreciation thereafter. By about 2015, it's 4% appreciation for this market area. You can also see the patterns of overbuilding and underbuilding that have occurred, as well as overvaluation and undervaluation. We think that based upon where the index is now and where it was during year 2010, keeping in mind that this index is about 24 to 36 months preemptive of market conditions, that we'll first feel stable market conditions in this area during year 2012. That will be the first stable year where we'll see price appreciation, and it will improve from there. Okay, so this is what it looks like graphically. Here we are in terms of the overall composite index of leading indicators, this thick blue line. The dotted green line is mortgage cost income index. The dotted light blue line is the jobs to housing index. Both will correct to equilibrium, reach that equilibrium by about 2014, 2015. So for this particular region, the Wasatch region economy has not yet begun to recover. It's still losing jobs, but at a decreasing rate. We don't think we'll actually see job growth until later this year. Housing construction is near an all-time low. That helps on the competitive supply side, and that's partly because small builders simply cannot get any financing to build homes right now. Housing affordability is near an all-time high. It actually even gets more affordable this year, as we'll see a continued drop in prices. A severe overcorrection is already well established. There is a continued high level of foreclosures and distressed housing inventory, and it's still trending downward in this market area. Marginal price depreciation will be apparent during year 2011, but prices will begin to recover during year 2012 and thereafter. The beginnings of market improvements, which we think first occur during the latter part of year 2011, or more specifically 2012, will be fueled by undervaluation as opposed to economic growth. It'll take a while for the economy to make up all of the jobs that it lost, but it will begin growing later this year and throughout year 2012 and beyond. But it's not until 2013, 2014 where the economy really begins to push the market, as opposed to these very strong values that are apparent now. The mature markets, for housing directed toward the buyer profile at ages 55 and older, as well as the apartment market, should do quite well during the next 5 years. That's based upon the demographic patterns that we're seeing in the Wasatch Front, as well as the type of jobs that are being created, the incomes that are there, and some other factors. We hope you've enjoyed this webinar. We'll post another one next week. For our contact information, please feel free to contact any of us here at Real Estate Economics for your consulting needs as well as your web-based information needs. Thanks. Take care.